Welcome to The Explainer. Today we're going to do something really cool. We're going to decode the genius of one of the world's greatest investors, Warren Buffett, and distill it all down into a powerful, four-step checklist that you can actually use.
Have you ever felt like investing is just way too complicated? All the charts, the jargon, it's just a lot to handle. But what if there was a clear, structured way to cut through all that noise and analyze a company just like the pros?
Well, that's exactly what this is. We're calling it the Buffett check, a straightforward, four-step framework that's designed to do one thing and one thing only: help you find those truly wonderful companies that are worth investing in for the long haul.
So here's our game plan. We're going to break it all down, pillar by pillar. We'll start with the business itself, then we'll look at the leadership, check out its financial strength, and finally we'll talk about the price.
All right, let's really dive into this roadmap. These are the four absolutely crucial areas you have to investigate before you even think about making an investment decision. If you can get these right, believe me, you're already way ahead of the game.
First up, Pillar 1, the business. Now, Buffett famously compares a great business to a strong castle. So our job is to inspect that castle and, maybe more importantly, the moat that's supposed to be defending it. So how do we do that? Well, we ask ourselves four pretty simple questions. First off, do you actually get what this company does? Can you explain it easily? Second, has it been around for a while with a stable history? Third, does it have something special that protects it from competitors? And finally, can it raise its prices without everyone running for the hills? A yes to all four of these? That's a very good sign.
And that brings us to this absolutely crucial idea, the economic moat. This is the key to a company's long-term survival. It could be a super powerful brand, like Coca-Cola's, or a network effect like Amazon has, or even just the high cost of switching, like with your bank. A wide, deep moat is what keeps the competition out and lets the profits roll in for years and years.
All right, so you found a great castle. But what about the people inside running the place? That brings us to our second pillar, management. You got to be able to trust the captains of the ship.
We're looking for three specific traits here. 1. Are they honest and totally transparent with their shareholders? 2. Do they make smart, rational decisions with the company's money? Like buying back stock when it's cheap, instead of making some crazy expensive acquisition. And 3, and this is a big one, do they resist following the herd and chasing silly industry fads?
Okay, next up, Pillar 3, the financials. Look, a great business with a great team is awesome, but it has to be backed up by the numbers, right? This is where we pop the hood and really check the performance of the engine room.
Now here are the key numbers that really matter, and don't worry, you don't need to be an accountant for this. We're just looking for some really clear signals of a healthy company: high profitability, not a lot of debt, strong and consistent profit margins, and of course, the ability to generate a ton of cash.
Now, if there's one number to really zero in on here, it's this one: return on equity, or ROE. This basically tells you how good the company is at turning shareholders' money into more profit. Buffett loves to see this consistently above 15%. Why? Because it's a huge sign that the company has one of those durable economic moats we were just talking about.
And finally, we get to Pillar 4, valuation. And honestly, this might be the most important step of the entire process. Because, let's be real, even the best company on the planet can be a terrible investment if you pay too much for it.
This right here, this is the absolute heart of value investing. You've got two numbers to think about. On one side, what a business is truly worth, its intrinsic value, and on the other, what you have to pay to own a piece of it today, the market price. The whole goal is just so simple. Buy it when the price is way below its actual value.
And that gap, the difference between what it's worth and what you pay, that has a special name: the margin of safety. Honestly, this is the bedrock of Buffett's entire philosophy. It's your safety net. It's what protects you if you make a mistake or if bad luck strikes. And it's also where all your future profits come from.
So how big of a gap are we looking for? Well, as a rule of thumb, Buffett is generally looking for a discount, a margin of safety of at least 20%. I mean, think about it. You're buying $1 worth of a great business for 80 cents or even less. That's how you lower your risk and set yourself up for great returns at the same time.
Okay, so let's recap. We have our four pillars: a fantastic business with a strong moat, honest and smart management, rock-solid financials, and, crucially, a discounted price. Now we can put it all together and make our final call.
And this quote from the man himself just says it all, doesn't it? It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's the whole point of this checklist, to help you find that wonderful company. So when you systematically run a company through these 4 tenets, you're not just guessing anymore. You're moving past the hype and the gut feelings. You're arriving at a clear, rational, long-term decision that's actually based on the fundamentals of the business.
So, what's the big takeaway here? It's that you now have the exact framework to start analyzing businesses like a legend. You've got the checklist, so the only real question left is, what wonderful company are you going to check first?